Okay, second time's a charm. Is it working now? Sorry, guys. I apologize. Welcome, Eric here, Mr. Fired Up Wealth. I apologize if you're on the other link. You should be able to find this one. I accidentally ended the stream after 15 seconds. So let's get started. I want to make sure this is working here. Last time what happened is I got a little bit impatient and I basically didn't think it was working because it took like 30 seconds and I freaked out and canceled the live stream. So I apologize. I know there's people probably sitting in the other channel. Hopefully they figured it out by now because I did post the other link. So welcome. Happy Saturday. Hope you're doing well. Can you guys hear and see me okay now? Please post and let me know. Keep the comments coming over here. Let me know that you can hear and see me and keep the questions. I'm going to do Q&A as I go through this. So hope you guys are having a great week. And I apologize for the technical difficulties this morning here on Saturday. So if you're new to the channel, what we're all about is outperform the market. Taking growth, outperforming the market over time. We're long-term investors, and we're going to convert that into dividend stocks and really passive income and live off of our dividends for early retirement, financial freedom. The nice thing about this community, though, it's very diverse. We invest in ETFs, dividends, growth stocks, spec stocks. It's not just one thing. It's a very rounded portfolio mix. We have people from 40 plus countries. We've got the community here in YouTube, which is very diverse, now close to 26,000. So thank you for that. And we also have a smaller niche private community. If anybody's interested in that, you can check out the links in the description. But definitely subscribe and click that bell to get notifications. So when I go live and I make a mistake like I did this morning, you'll get an update and be able to find me right away. Also hit the like button if this video is helpful. I'm going to turn some of this stuff off here and you should be able to see my screen. Okay, cool. So Nasdaq dropped 3.8% this week, notching its seventh straight weekly drop, longest weekly losing streak since 2001. That was the dot-com bubble. 29% off the record reached in November, so we're about 30% down. I hear a lot of people say, I'm 30% down on my portfolio. It's like, well, the whole index is. I mean, even Amazon is down like 50% or whatever from, not quite 50%, but you catch my drift, from its all-time highs. So the S&P 500 also briefly fell into a bear market yesterday on Friday, and that was 20% from its high. And the high actually on the QQQ was more towards, it was more towards November on the QQQ, and on the S&P 500, it was actually January 5th, I believe is the date. So we got some questions coming in, and I'm gonna jump right into those in a second. Before I do that, I want to do a couple things. So Nasdaq dropped 3.8% this week, notching its seventh straight weekly drop. That's big. We just kind of covered that. And it's funny, if you weren't paying attention to the market on Friday, you might have gone to work in the morning, come home and checked and said, oh, S&P 500 didn't do anything. It closed flat. The Dow Jones was pretty much flat. Nasdaq was down 0.3%. That's nothing. Well, intraday, we had huge movements and we actually touched some critical levels. We'll get to some charts and some technical analysis later. I'll let you know my opinions of where we might go next. We'll also talk about some specific growth stocks. I want to cover some more news though. So this is interesting. This is from Bloomberg, and I did tweet this. Now, if you don't follow me on Twitter, the handle is just Fired Up Wealth. Let's see if I can find the banner. Where is that banner? Here. Welcome banner. Here it is. I'm still getting used to this stream deck. You guys, I'm not a streamer at all, so I'm doing my best. I felt like the first couple I did were pretty good. Today, I wasn't actually going to do one. I kind of had a rough night last night, didn't sleep very well, so I was thinking about not doing it. But then I had this tweet go viral last night, and it really inspired me. Like, hey man, I need to get in front of people. They need my help. They want some guidance. I'm not a financial advisor. I can't tell you what to do with your money, but you want some guidance. But follow me on Twitter. The handle is Fired Up Wealth. And I posted last night a few different things. I posted this as well. But if you look at this is from Bloomberg. So if you look at this, so Wall Street analysts try to keep pace, blah, blah, blah. We're talking about algorithms. Algorithms a lot of times use data like this, and it'll look for percentages. It'll look for technical analysis like Fibonacci's. It uses a bunch of different variables, and nobody really knows the code. It's kind of like the YouTube algorithm. Once you figure it out, it kind of changes. The S&P 500 fell to 3,810 during Friday's session yesterday, roughly 20.6% below its record close on January 3rd. I think it said January 5th. I was off by 2 days, January 3rd, and rebounded to cut the loss to 18.7%. So as we sit right now, as of Friday's close, we're 18.7. That's a pretty massive swing. The levels could be dismissed as trivial except for this nagging fact. History holds a large number of examples for rebounds like this. 1998, 2011, 2018, the benchmark slid either below the 20% level or very near it on an intraday basis, only to reverse itself and never test bear market waters again. So is at the bottom, was there capitulation? Your guess is as good as mine. Let me know in the comments. Let everybody know what you think in the comments. But I think it's certainly a possibility, and I also think we could go much lower, so I'm not naive to that fact. And as a long-term investor, I'm positioned either way. I'm ready to add. I'm very tactical on what I'm doing. I've got enough cash for the next leg down. Eventually, if there's too many legs down, you're going to run out of cash. But I'm prepared for another leg down. I'll show you what those levels are in the chart here in a little bit. And if I look at kind of what happened this week, so we had Target. So Target was down 25%, trading like a penny stock. I mean, 25% is a massive move for a company like Target. And it got down to something like, tell me guys, 11, 12 PE ratios. So pretty inexpensive, pays a couple percent dividend yield. Essentially what's going on with Walmart and with Target, with a lot of these, essentially the consumer is spending money. So they're actually hitting their revenue numbers. They're just not hitting the earnings per share. So people are spending money, but they're not as profitable in the earnings per share. And for the reason for that, you have things like supply chain issues. You've got labor force inflation, increase in labor, with hourly wages, things like that. You got shipping charges, all the things you already know about, gas charges, fuel charges, and so on. So it says here they saw a healthy customer, but a shift to experience-based purchases, such as toys for birthday parties or luggage for trips. So this is actually really interesting. Luggage for trips, does that create an opportunity for Bookings Holdings, Expedia, Airbnb, maybe some of the hotel operators? Maybe that's a tell sign. But then at the same time, if we're going to a recession, then maybe, if the market's forward looking, who knows what's going to happen, in 6 months, 12 months, whatever. It's a really interesting spot here because everybody has this doom and gloom, like it has to go lower. And there's definitely a case for that bear case, but there's not enough people talking about the possibility that it doesn't have to happen either. So instead of me saying like, I know for a fact that I can, I have a crystal ball and I can tell you exactly what the market's going to do, I give you possibilities and facts and you make your own thesis. I'm not here to try to convince you. I'm not one of those guys like the bottom was in yesterday and you absolutely must buy. I'm telling you like, here's what can happen. And if you have that mindset, it's much easier to navigate this kind of market because it's a rough market, right? So you can see earnings per share. So 219 adjusted versus 307 expected. That's a big miss. I don't know if 25% of the market cap is really, that might be overdone, but that's what the market is going to do. Anytime you have an earnings miss, the market's going to crucify you in this kind of environment. The revenue actually beat. So like we said, revenue is going to beat, but earnings per share profitability is down. Target stores and website traffic rose 3.9%. And you can say sales did grow compared to that year ago period, which I think is interesting. Comparable sales, a key metric that tracks sales at store opens at least 13 months and online, grew 3.3%. That's healthy for retail on top of 23% increase a year ago. So when you just look at the revenue, it's actually showing a pretty strong consumer. But then you look at the profitability and you've got problems with supply chain and everything else that we talk about. And there's another image here. I want to go through a couple of these here. Where is that one? I'm going to go through all these guys. Sorry, I don't have these organized very well. National gas. Well, this is a good one here. So gas went up to $4.50 on May 14th. That's as expensive as it's been in a while. Back in 2009, it got to $4.11. And you can argue with inflation, it makes sense because, $4.47, this was probably more expensive if you use it on an inflation basis, right? We're going to look at some charts and things like that too. There's a couple different interesting things in here that we want to go through. So here's Walmart, Target, Home Depot, Lowe's. Now, Home Depot beat on both, and they had probably the strongest quarter out of these big box retailers. But they all kind of said the same thing. We're experiencing high levels of inflation, international markets over the years. Analysts, investors didn't anticipate Walmart and Target would have a massive hit on their profits the way they did. So is it a management issue? Is it something that they couldn't have done anything better with? It's just, that's the environment we're in. And this is why the market is so, bearish right now, because we've got this inflation issue and it doesn't seem to be getting any better. And the market's not going to like that. We also have quantitative tightening, which the market's not going to like that. So it's easy to make that bear case to say, hey, we have to go much lower based on Schiller PE, based on this, based on that. If you look at some of this, we do have earnings. And so earnings coming up this week. I'm going to leave this up here so you can see it. And while I do that, I want to read through some questions and we'll make this a little interactive here. So if this is helpful, guys, make sure to like, and then this is going to be recorded. So come back later and watch and drop a comment on that left-hand side to help me out, and subscribe if you haven't. Let me see here. I'm not going to turn that on because you won't be able to see. I'm blocking a couple here. I'm blocking a couple things here. Let me make that a little smaller. Can you guys see that better now? You should be able to see, make it a little smaller. You should be able to see everything now. So, interesting. So this camera's lagging this camera. There we go. That one's caught up now. Oh, the like button's still on. We'll turn that off. Sorry, guys. Okay, so James Long, hi, how you doing? Duncan, what's up? Anil, what's good? Derek, all good. Caleb, hello. Sabu, Sam, Ben, hey guys, everybody. Yanni, have you had time to watch Kathy Wood's inflation deflation video? I have not. A couple people asked me about that. I will hopefully this weekend. Brandon asked me, would love to hear your thoughts on your stocks outperformance versus the S&P past and future. We'll talk more about some of that and look at charts and things later. Sam, how's it going? Why haven't you guys swapped out of growth stocks into natural resources? I think the reason for that is a lot of people in here are thinking more long-term. So they're looking at 5 and 10 years. So they're trying to accumulate shares. In the short term, a lot of those natural resources plays would be good trades. And you might have, you might even make money for the next several years. So there are members in the community that do have commodities that are diversified into gold, that are diversified into other things. So it's the thing about with YouTube, what most people want to focus on is the growth part. The rest of it's really not that complicated. Like if you're going to invest in that stuff, it's really not that complex, and it's not something you're going to talk about. So we build our portfolios with diversified, with growth being part of it. And depending on your risk tolerance, your suitability, your age, all that, you're going to build your own portfolio. So it's not like everybody's just buying all hyper growth stocks. In fact, about 35% or so of my portfolio is dividend stocks, quality blue chip dividend type stocks. And I've got a lot of mega cap tech, and I've got a portion of my portfolio that's dedicated to those hyper growth stocks, but with a, 2030 time horizon, right? So, you're not just buying all growth stocks, and I want to make sure that we're clear on that. So, with Walmart and Target's results, it appears supply-demand deflation coming, very possible. Work hard, play hard. Let's talk about valuations on the likes of Snow, Crowd, Datadog. Tacos going cray-cray this morning. Need some breakfast. Rob Fisher, people running out of stimmy checks. Yeah. What else is going on here? I'm trying to find questions and not just comments, I guess. Debonka, is Target, Walmart, Lowe's, high depth? I guess start with questions now because I think some things got buried from some of this chatter, guys. So it's hard to read this and try to be interactive when you've got a lot of trash in there too. Debonka, though, is a Target, Walmart, Lowe's, Home Depot with massive drops better bets, reasonable prices with recession looming? Well, that's the $1 million question. I think if you're investing in those, you know that there could be more pain, that they're probably not going to go back to all-time highs anytime soon. And you're really going to buy those as part of the dividend portfolio with a longer term thesis. But if there is a longer term recessionary period, like all stocks are going to get hit, right? So you have to kind of do what's best for you on that. Thanks for doing the live stream. Next week, I'm going to be off because I do have an anniversary trip planned. So this is the third week in a row. We'll take a week off next week. James Long, to get on energy now is a bit late to the party. Buy low, sell high. Probably a good point. She said her 5-year time horizon turned into a 50-year time horizon. Who said that? Kathy said that. Have you heard that Congress will launch a bipartisan effort to break up Google's advertising? Yeah, we talked about that in Discord. I mean, that kind of stuff has been in the talks for years, breaking up antitrust with all the big mega cap tech. It's part of the reason Google doesn't trade at a higher valuation. It's sitting, 20 PE or even 19 or something, because people are worried what that looks like. A lot of times when you break up those big companies, it actually unlocks value. So it could be a good thing, depending on how that all plays out. So earnings coming up this week, we've got Zoom on after close on Monday. We've got, you can kind of see on here, WalkMe is one that's, I think, is interesting. I don't own that one, but it's very interesting. We've got Best Buy. That'll be interesting to see on Tuesday morning. AutoZone. That'll be good to get a handle on kind of the used auto market a little bit. Into it after close on Tuesday, we've got Toll Brothers. NVIDIA is coming up after close on Wednesday. That's a big one. Snowflake as well on that day. So mark your calendars for Wednesday coming up this week. We also got Box and a bunch of other ones after. We got Costco, Alibaba, Marvell Technologies, Zscaler, Autodesk, Dollar General. Big day again on Thursday. And then Friday looks like Canopy Growth, Big Lots, and a few others. So it'll be a big week for earnings again, especially that Wednesday one with NVIDIA and Snowflake. So it should be interesting to see how those guys report. You're looking at the percentage. Now, this is actually a couple days old, so it's worse than this now on some of this. NASDAQ percentage of stocks above the 200-day moving average. So if you look at this, guys, I need to zoom in a little bit there. I know that it's not the best graphic in the world, but you get the idea. So if you look at, this is the overall, the black here is the overall index, right? And this is the Nasdaq Index, right? So we're at 11,967 there. If you look at this red squiggly line, this is going to be the percentage of stocks above the 200-day moving average. So we're down here, right? And if you look at 2020 on the kind of crash sell-off for COVID, we got down quite a bit lower. So some people think we need to get down in here. And you can see some of these 2018, 2019, 2016. This is the big one here, 2009. This is the whole housing crisis, the financial crisis, the Great Recession, I think they call it, right? So that's the question. A lot of people are looking at technical analysis on charts, and they're saying, the charts have to go much lower because it has to kind of come back to these levels. Maybe it goes back to pandemic levels. Well, that's a little bit lower yet. Maybe it comes back all the way to 2009. Well, that's quite a bit lower. And this is where you can start building a bearish thesis. Again, there's ways to build both sides. What we really need is clarity, and we don't have it. And the market's not going to really be happy until it has some sort of clarity. We have to have clarity on inflation. It's even possible, we've talked about this for a while, that the Fed could even reduce rates and kind of roll back in 2023. If inflation starts to settle down, that's a possibility. I'm not saying that it's going to happen for sure. I'm just saying it's a possibility. And so if you look at this next one, this is an interesting chart here. This is actually showing us, what I want to point out to this is the S&P 500. So I'm going to circle this here. So this is the forward P ratio. It's 16.7 right now, okay? The 5-year average is 16.7, and the S&P forward PE, 16.7. So it's kind of interesting. Algos sometimes will do things like this, get to an exact number. You'll notice that if you look within the other sectors, you're going to have disparity. And this is why some people can trade, the sector ETFs and ride momentum. It's also why a lot of retail investors underperform because they chase. So like someone earlier mentioned getting into oil. Maybe he's right and it's a secular commodity and oil, mega trend. Maybe that's correct. But a lot of times it's not. And so what happens is you say, okay, I'm going to go buy oil and commodities, and these sectors are, up here, and then you're going to chase them, and then, everything's going to rotate back into technology, and retail often is chasing. It's like the dog chasing his tail. And so when someone asks me a question like, why would you invest in technology? It's because I'm a long-term investor and that's where the growth's going to be. It doesn't mean that those stocks are going to perform well over the next couple of years, but that's not my target. So you have to do what's best for you, right? But you can see, like, if I look at the 4P ratio of the overall S&P 500, it's 16.7 right here. If I look at healthcare, 15.4, financials are always a bit lower. The consumer discretionary is 22, technology is still 19.8. And so on. But here's the materials sector. This is actually 18.4. And the P ratio, the forward though is 13.7. And what's interesting, if you look at the 5-year forward PE, it's 17.7. So I think it's just really interesting. You also can look at dividend yields. You look at treasury yields and say, okay, well, the 10-year treasury, once it goes over 3%, then, it affects stocks because you're looking at the forward dividend yield of the S&P versus bonds for people that are trying to, preserve capital versus appreciate. And that's another thing too. Why would you invest in technology? If you're trying to preserve capital, you're probably not. You're probably investing very differently. If you're trying to appreciate wealth over a 5, 10, 15, 20-year period, well, then you're going to be investing in probably more technology, more growth, more risk reward there. So interesting numbers there to look at, but I think it's interesting how we got exactly to the 16.7. You could argue it needs to be lower than that. And you can look at things like Schiller PE, which you could argue is outdated. We're still, really elevated on that too. So this is another good chart here. S&P 500 worst performance through 95 days. This is from 1928 to 2022. Now, somebody on Twitter, a couple of people on Twitter have been posting about, the VIX has to spike to 40, and there's never been a recession, there's never been a recession since 1929 that didn't have a VIX spike to X percent. It's like, well, first of all, the VIX was created in 1993. Options started in 1970, and it's based off options trading. So, to compare it to 1929, you got to be careful with some of the misinformation out there and who you're following on Twitter, guys. So if I look at this, though, we're in 2022. This is actually lower now. We actually got down to 20%, like we talked about earlier, and we're a little bit lower than this now. This is from a few days ago. And if you look at 1932, the price return day 96 to year end was 27%. The full year was negative 14%. And it's just interesting to see this. It doesn't really mean it's going to follow this or anything, but this is the second worst performance for the first 95 trading days other than 1932. And then if you look below it, 1939, 1970, 1940, these are historic times. Some really ugly dates in here, 1937, 1942, 1931, talking dirty 30s with a lot of these numbers. So that's where people get kind of scared, and rightfully so. I mean, especially if you're a new investor, it can be hard to navigate these times. So I've been investing for almost 25 years. I'm always very long focused, and that's just how I am. You got to do what's best for you. Some people like to day trade. Some people like to swing trade. Some people, whatever you're into. What I'm into is buying quality companies and holding them for the long term. And that's what I've done for 25 years. And I've built millions of dollars of wealth doing it. And I'm going to continue to do it until I get to my target date in 2030. And then I'm going to convert it into passive income and enjoy life. And that's the journey I'm taking. So definitely subscribe and, hit like. If this is something that's useful, subscribe, click the bell to get notifications so that when I do these videos, you get notifications and you can come join us. So if I look at this here, this is cash levels, highest since 9/11. So right now we're the highest since 9/11. You can see back in 2000, it was even higher. We're even higher than 2020. We're higher than 2008. So this is the cash levels rise to the highest since 9/11. So going all the way back to 9/11. This is from Bank of America. So interesting stuff there. And this is also interesting too, because if you look at this now, this is 2021. And in the gold color, this is tech stocks. You can see we had this big run, 582%. Well, commodities were down 34%. And so this other gentleman earlier, Taco, was talking about why don't you swap into that? And that's something that certainly you could look at something like this and say, yeah, you could swap into that and then ride. Commodities are up 253% and this is down. So you basically flip flop and ride these waves up. So you'd be selling tech here, buying commodities here. And then when they crisscross again, you switch. And some people do that and they do that well. It just depends on your strategy, and there's no wrong answer. It just really depends on what you're comfortable with and what you like to invest your money in. So we're going to look at some charts here. I'll put this up. I'm going to go through some questions, and then I'll start going through some charts and looking at some other stocks here. So I'm probably going to miss a lot today. There's a lot of questions. I appreciate it. I'll do my best here. Let me scroll up a little bit and just go through some of this. Thoughts on Roku is the second largest holding in ARK. Roku's one of those stocks that it's speculative, but you can make a case where, my old bearish case on Roku is like, what moat do they have? Because Amazon Fire Stick, you've got Google, you've got, Apple TV, all these guys can do the same thing. But when you talk to people that use Roku, they really like Roku. It's easy to use. Like anybody can use it. Your great grandma can use it. Very simple remote, very inexpensive. It's in a lot of TVs. So there's definitely risk there. There's no question. And, my thoughts on it being the second holding in ARK, there's a lot of things that I'm not sure about on ARK that I personally wouldn't do. And I'm not bashing ARK. I mean, I own a little bit of ARK as spec in retirement, but it's certainly not a very big piece of my wealth. And I would rather just invest in individual stocks most of the time, especially in my taxable brokerage. That's my focus. I've got about 9% ETFs in my taxable. The rest is in individual stocks. Upwork or Fiverr, I would go with Fiverr personally. I've used both. I've used both, and I prefer Fiverr, but they're both decent. I think it's hard to really have a moat in that space too. So we look at, see, thanks E for your time. Always great videos. Appreciate it. Welcome from Belgium. Hello. Why the huge rise up after Friday's drop? We kind of talked about that, Jeremiah. I think the algos kind of kicked in when we got to that magic number, that 20% bear market to make it official. And a lot of traders and algos probably kicked in and said maybe that was enough, at least in the short term. But longer term, who knows? You could always retest, go lower, could drag on for a long time. There's a lot of unknowns that we just don't have answers to right now. If a recession in two Qs of negative growth and Q2 not looking good, do you think we're already in a recession? I've said this many times. I think the answer is yes. In the first quarter, we had a negative 1% read on GDP, and we'll probably have a slightly negative read. And maybe I'm wrong, but I think we'll have that at the end of this quarter. We'll have another negative read and be in an official recession. But that's to be determined when we get the results. So it's a good possibility, though. What do you think about Team? I think it's all right. I used to use it for work, and I'm not a big fan of it personally, so that's why I don't own it, because I hated using it. But I'm weird like that. There's a lot of stocks that Zoom Info is another one that I used to use for work, and I'm just not a big fan of it. But you look at the company, solid company. Look at the numbers, the growth. Good company. I can't own everything though, and just giving you my honest answer. Do you think Tesla has a key man issue? You're talking about Elon Musk. Given so much of their valuation relies on Musk. I mean, you could argue that with NVIDIA. You could argue that. Think of like Steve Jobs when he was running Apple, and that did impact the stock for a while. So yeah, there's certainly risk there. If something happened to one of these big name CEOs, it would certainly impact the stock price, especially in the short term. I could make a case, and I'm probably going to be doing an investing panel pretty soon. I'm not sure if it's going to be on YouTube or how we're going to do it yet, but I want to I have a few people in mind. I like to get maybe 4 people and do a Zoom call and talk about Tesla, because the thing about Tesla is that I could argue that it's not really that expensive here. And I know you'll laugh at me, but like, it's funny because I'll see people buying something like Snowflake that's insanely expensive still. And I buy it, and I know it's expensive, and I know it could go much, much lower. But those same people are buying Snowflake will sit there and troll and say, Tesla's too expensive. I'm not buying that piece of junk till it's $250. And you're like, what are you talking about, dude? It's like, what is 80 PE? Okay, that's expensive. 90 PE, whatever it is. It's under 100, especially, it got down to $630 or whatever it was. We'll open up a Tesla chart when I'm talking about Tesla. And, this is just algo selling. We had some news on Elon and blah, blah, blah. I won't even go into it. The story. This got down to $630 or so. And if you look at the PE ratio on that, let's just look at Tesla stock. So this actually, I want to look at this daily. It got down to 633 or so here intraday. And so it started up here at $714. It dropped down to $644, if you can see that here. So it started up here, dropped down 135, 130. This is when the S&P kind of hit that 20% and the algos kind of kicked in. It closed at 663. That's a big swing, and that's a big move off the bounce. And it's right now, according to Google Finance, it's an 89.73 PE ratio, you can see. And 52-week low, 546, 52-week high, 1243. If you look back the last 8 quarters, every single quarter this PE ratio gets lower and lower and lower. So like they're growing so fast that they can grow into this PE ratio. The longer the stock goes sideways or goes lower, the more opportunity it creates for the stock. So for me personally, I look at this and I'm like, if I had to choose between like a Snowflake and Tesla, I'd probably go with Tesla. I mean, people are going to say it's expensive and laugh at me, but it's compared to the hyper growth stocks that you guys buy that you probably don't understand, this is cheaper. So I don't really get the logic sometimes of why people are so bear and bull. So you could even say that, yeah, Elon Musk is a big part of that, but without Elon Musk, it's still a market cap of $687 billion. It used to be over $1 billion. Their revenue in 2022 Q1 was $18.76 billion. This is a real company. And there's a lot of total addressable market that people don't even talk about. And you think of So look at like their FSD. If they have $199 or $299, whatever it is, per person, and they get millions of people, it's essentially like a software as a service model now with recurring revenues. And that's not even really baked into this price. Then you got like the bots that Derek talked about on our platinum call. That's a long shot, but that's not even baked into this price at all. You know what I mean? So like, just think about it. They could even lease some of their artificial intelligence rights to other companies like Ford, GM, and so on. And I like Tesla, and I'm a fan of Tesla, but I'm not necessarily like one of those guys that's like, mega bull that you have to buy it when it's $1,200 a share. But when it's down here at $650, could it go in the 500s? Yeah. But I'm saying the lower it goes, the more opportunity that's going to create. That's all I'm saying. So keep an eye on Tesla. Cool. Is snow going to drop post earnings? Matt, I wish I had a crystal ball. I'm prepared for it in case. I'm going to have some cash ready. I think the lowest that you probably see on Snowflake, if you want my honest opinion, we could probably do some metrics on this. This circle down here is probably the lowest I see it. This is between $100 and $120. Could it go lower than that? Sure. I think this is very possible if the market continues to break down, and this is where I'd be adding more personally for my position. But it could find a base here too. You can see that it got down to $125, $126. This is still really the most expensive, stock. If I look I'm going to open up Discord and actually read a couple things from last night that the team was talking about in the cloud channel. So we've got a cloud channel here in Discord, Cloud SaaS. And if you don't follow Clouded Judgment on Twitter, he's a good follow as well. Snowflake is 20.2 EV/NTM. Cloudflare is a 17.4, Datadog 16.5, CrowdStrike 15.5, Zscaler 15.3, so on. If I look at, and it's put in the SaaS bucket, but really it's database as a service. It's based on consumption. So Snowflake is a little bit different because it's not like a true SaaS play. Like if you look at a Datadog or a CrowdStrike or something like that, money.com is 100% revenues off of SaaS with 90% or 89% margins. So, and Snowflake, their gross margin is 62%. And so Snowflake, people ask, well, how do you value it? I tell most people that you probably shouldn't buy Snowflake because if you don't understand it, it is expensive. There is speculation and you could get hurt. So if you don't have conviction to understand it, you shouldn't buy it. I buy it because I have conviction in the long-term thesis, and I've projected. I've spent 200 hours or so on this company researching it. Frank Slootman is someone I've followed since before even ServiceNow, and made a lot of money at ServiceNow when he was a CEO there. And I have confidence in that management team. I know people that work in the organization, in the sales team, and I have really high conviction in Snowflake. But most people probably shouldn't invest in it if they don't understand it. And if they are, they probably should have it in their spec bucket and know that it could be a 10x or zero type thing. I don't think it'll really go to zero, but you know what I mean? It could definitely go a lot lower. So for me, I think it's going to be an advertising tech giant. I think there's some really interesting things that they're doing with BlackRock, with there's this Trade Desk is one of their partners. There's some really cool stuff, and I've got some videos in the channel if you want to explore that more. So, Kathy Wood predicted in 2020 oil prices would crash to $12 a barrel. Taco is still talking about oil. Yeah, I mean, there's certainly been good and bad calls when it comes to oil. There's no question there. It's been a crazy couple of years, and oil's done really well if you invest in oil. So, congratulations to anybody that rode that train. Good morning, Connor. Dubanka, is it better to buy the index now with the big drops versus getting hammered with individual stocks? That's a really good question, and I talked about this last night. In fact, Pork Shop asked me this question in our Discord community. If you're interested in joining Discord, guys, there's a link in the description of the video, and there's actually a free one, and there's also a couple of other ones. But what I'm going to read you right now is something you could get for free. You could have read this. It's under Ask Eric Anything. And he asked me the question, he added a ton of growth stocks. So positions like DGIF stocks, dividend growth investing for fired, total growth stocks. He's asking, should I buy DGI, dividend stocks and ETFs right now, or growth stocks? I'm looking at John Deere, Bank of America, QQQ, and so on. And I said, hello? It seems like it rotated to the generals. So the generals get shot last kind of a thing. You look at NVIDIA, you look at, AMD, Tesla, Apple, those kind of Microsoft. Those are like the last ones to kind of roll over here. So what I said, if you look at the Fired Up Wealth community portfolio buys, so we've got a community portfolio. If you're not familiar, there is a playlist on the channel. We started a portfolio from scratch, a growth portfolio about 2 months ago, and been basically dollar cost averaging. And I share those buys in Discord. And then even the $10 patrons get email updates at the end of the day of what we're buying. But if you watch what I've been buying, most of those growth stocks had already bottomed last week. And most of those growth stocks, like Snowflake, is 10% higher right now than it was last Thursday. And so most people aren't probably buying that. They're buying the next thing that kind of rolled over. So when you look at yesterday, you're buying things like Tesla and Nvidia and Apple and stuff like that that's rolled over. And so what I said was, if you follow the Fired Up Wealth community portfolio buys, our investing club, it's followed this trend overall. With that said, high quality and high growth was being hit today. The generals, like Tesla, Nvidia, which the group was buying, and others. John Deere could go below $300. So watch that. It's hard because buying QQQ here might help fill your blueprint. So blueprint, we talk about building a blueprint to build a portfolio that makes sense for your needs. If you're going to build a house, you have to have a blueprint first to know where all the materials go. So you've got ETFs, dividend stocks, growth stocks, that balance that I talked about earlier. So I'm talking about if it fits in your blueprint, it could help fill your blueprint. But then, like say an upstart could be a 10x, or it could be a bust type of thing, 10x or 0 type of thing. Lots of risk reward decisions to make. But if your blueprint requires, say, Target that sold off 25% and is now a 12 PE ratio, that could be an opportunity indeed. And then I say, I think the answer overall is that stock pickers will win the most in this environment. So an ETF may fill your blueprint at a discount, but it certainly has less upside than some individual stock names that get thrown out with the bath. So you're trying, everything gets sold off. The baby gets thrown out with the bathwater, they say. And you got to go be a stock picker and find those diamonds in the rough, the needles in the haystack. And what I say is that it certainly has less upside than some individual stock names, also less downside. It's a risk reward thing. Hence the risk reward scenario, a stock picker's dream. And I feel very confident about what I'm buying here and lower from these levels for my personal blueprint that's designed for 2030 and beyond. Cheers and have a nice weekend. So that's my thoughts on that. I'm going to add Nvidia after earnings. It'll be interesting to see how earnings go. I think in the 150s yesterday wasn't a terrible ad, but maybe it goes lower. Who knows? I'm personally excited for the opportunities right now watching Snow, Nvidia, Costco. Yeah, those are good companies. I own all three of those. Growth investors got screwed by the Fed. 2 years in proof, unrealized gains, now paper losses, and worse for many, conviction, high quality. Tesla, I sold the last share I bought, holding the rest of Tesla, 440. What's going on here? Let me just go back up here. We got a lot of stuff. I'm doing my best, guys. Thanks for all the questions here. The next few at 440, you're talking about Tesla. Yeah, it'd be great if it got that low. I don't think it's going to go that low. Hi, Eric. When are you going to share your portfolio like you used to? I share my portfolio buys and sells in Discord. What do you think about Cramer's suggestion that the Fed should end the pain by a massive interest rate increase 1% or more? It's interesting. I think that they're so behind the eight ball now, it's hard for them. It's a lose-lose deal, but it could help. The market actually might like that in some ways. So just bought my first Target share. Nice. Do you have any thoughts on Intel stock? A lot of people in the group own it. I'm not a big fan of it, but it is, something that I hope it does well. I really want Intel to do well, build out their US, foundries and things like that. So what else? I'm thinking about getting into BABA, Fed Fueled. Roku's interface is excellent. Thoughts on Alibaba and Carnival Cruise. Thoughts on Alibaba and Carnival Cruise Line. I'm not a fan of either. There's my take on that. Just bought my first Target. Is Roku profitable? I do not believe. Well, I think it has a PE ratio actually, but it's really expensive. According to this quick search, it's a 96.69 PE ratio. So very expensive, but it does have the earnings there. We don't all have Bloomberg terminals. Let's see. I'm a holder. What about Splunk? I'm more of a Datadog guy. CPNG, not a fan. Roblox, yeah, I like Roblox. We can look at Roblox. Roblox. I said, bounce or S2, and it basically went past the S2 here, and it actually bounced pretty good, and it sold back down to 30 and then bounced off 30 yesterday. So, this thing's been hammered. This was a pretty good opportunity in the 20s. I know I added some there. But yeah, cost basis isn't as good as it could be on some of those like Roblox. Those new IPOs, I've said this before, but they were expensive when they came to the market. They got rallied way up. Definitely I was buying at $65 is generally what I was buying Roblox, but that's still 50% higher than here. And I've added, so I got my cost basis down. I'm probably down 30, 40% on it, but I'm holding it long term. Not too worried about that one personally. So I like Qualcomm. I've owned it for 5 or 6, 7 years. It's a good one. Good dividend. You're asking me about a bunch of stocks there. So, you got 1, 2, 3, 4, 5. Walgreens, I'm probably more of a CVS guy. Verizon's an income stock, so it's not really going to give you much appreciation on the stock price, but it'll give you a good dividend. Unity Software, I like Unity Software still. Why is everybody so bullish in the U.S.? I don't know very many people that are bullish in the U.S., to be honest with you. I lost everything in the last few months. Did you lose it? Or do you sell, or is it just your paper gains are down? You know what I mean? So people are like, how much have you lost? Like, I haven't lost anything because I haven't sold anything, So, I took some profits back in November, but you haven't lost it until you sold. So, I know it's hard. It comes back to that whole psychology. Dave hates 808s. You were actually yesterday in the Bros video. So Dutch Bros, we did an exclusive video, Matt and I from the community. It's about an hour and 20 minutes. Go check that out after this if you want to explore more about Dutch Bros. So remember, you're the man, Philly guy. I appreciate it. Could you please take a look at ATN? I don't know that one. Follow up in the index individual discussion is trying to squeak more return out of individual stock. I think I covered that, right? I heard the ticker from my uncle. What do you think? SPY. That is just the S&P 500. It's more of a trading instrument. It has more liquidity. If you're looking for a long-term investment for the S&P 500, you would look at the VOO. That's VOO. That's the Vanguard S&P. That has a 0.03% expense ratio, and the SPY is much higher. I don't know exactly what it is, but it's quite a bit higher than that. Maybe Let's look. I'll look. So the VOO, let's see if I was right. 0.03 expense ratio. Oh, it's not going to have it on here. Never mind. I thought I was on Fidelity. But the SPY is higher. If you're going to trade, SPY's got more liquidity. Long term, you're looking more at the VOO. What do you think of ASML? I've got a video on the channel that covers top semiconductor stocks, and that one's one of the top picks. So if you're interested in my take on that, go check that out. There's Semiconductors, the New Oil. It's an entire playlist on the channel. What are your thoughts on PayPal? I think it has a long road up, but the company itself should be fine longer term. Opinion on apps. If you want to know, if you want information about Digital Turbine, you need to subscribe to the channel and go find the Digital Turbine videos. We've got 2 deep dive videos that goes into Digital Turbine. I'm bullish on it, and if you want more background, check out those videos in the channel. Make sure you subscribe. Thoughts on QS? That's one I don't really follow. 15% China allocation. Yeah, there's certainly possible opportunity. There's certainly risk too, with some of that. So it just depends on, everybody's different with what they want to invest in and what their risk tolerance is. UiPath, I think, it was good. It was just really expensive. I think longer term be all right. Thoughts on Cisco earnings? I don't think they were as bad as the market thought, but Cisco's certainly not growing. They're very old and they are losing. When I look at the digital side of the house, they are losing to Fortinet and a couple other names in there. So, it's not something I personally have invested in at this point. It's a dividend type stock. Croc stock, it seems interesting to me. I'm not really a consumer products kind of a investor, but there's a lot of good information online. Motley Fool's done a lot of stuff on Crocs, some good articles you can check out. Thoughts on Block Square? I like it long. It's, it ran really hard. I've been invested in Square since 2017, and I've never sold it. And it was up a lot and came back down. I'm still green on it, but not nearly as green as I was, of course. So I lost 100K. Did you lose it or did you sell? So let's see. Thoughts on ARR? Don't know that one. There's a lot of stock. I'm not gonna BS you guys. Like if you throw a ticker that I don't know, I'm not gonna pretend. I'm just gonna tell you I don't know it. there's thousands of stocks in the world, and I can't be an expert on all of them. And the ones that I do know, I know very, very well. I would argue as good as anybody, but that list is probably 200 stocks. And outside of that, I'm just going to tell you it's not my area. My area of expertise, I used to work in software. So if you're not familiar with my background, been investing over 20 years, almost 25 years, not just in stock market, but real estate. Own a couple restaurants that I'm part owners in, and we've had a dozen rental properties or so over the years, my wife and I. And I quit my software sales executive job. I was making $150K base plus commission to do this full time. Sometimes I question my life's decisions, but I had a good career there. I was in real estate for about 10 years. Then I was in software for about 12 years and started in on-prem and then more hybrid. And then the end of my career was more in the SaaS space. So my area of expertise is really going to be around technology, specifically software as a service, as well as semiconductors. And those are my kind of focus areas. The majority of my portfolio is either in those or more of the blue chip names. And I do have some like diamond in the rough DGI type plays that I think will be really good that we buy in the community as well. Sentinel-1 is it burns a lot of cash. So, CrowdStrike is probably healthier, but Sentinel-1 has a higher growth rate. In this environment, Sentinel-1's not going to be very popular. But there's a lot of total addressable market, but also a lot of competition and endpoint. So is Visa a buy right now? Visa is still not cheap if you look at the price of sales, PE ratios, things like that. I like the stock, but I don't necessarily think it's cheap. Thanks for the $1.99. Thoughts on Confluent and Hashicorp. I own both of those, and I like both of them. They're the freemium type models, so they're a little bit different because they're not true like Datadog or Monday.com, like true SaaS, built in the cloud for the cloud. They're more of that freemium. You think of MongoDB, Elastic, you think of Confluent, you think of Hashicorp. Those are the ones where you've got the free version and then you got bolt-ons, and it's a little bit more complicated, a little harder to value those. Both of those came to the market very expensive and were thrashed. I think both of those, if you talk to anybody in the space, are going to tell you that both of those have very good long-term potential, maybe some speculation with that. But I think both of those could be big winners, and I do own both of those. Confluent, I've been buying for a while, and I'm down on that one. Hashicorp, I just started getting into, so I've got a lot better cost basis on that one. So Upstart, 10x or zero. I've got a video. The Tremendous 12 that you can check out. If you go to patreon.com, Fired Up Wealth, there's a $10 tier, and you get access to, there's this video, the Tremendous 12. There's a Datadog exclusive. There's several others, but you get the exclusive videos. So I do tons of videos for free on YouTube. In fact, this is my 4th video this week. I did a video on Bros. I did a video on Monday.com, on Bill.com. If you haven't watched those, go check those out after this. And this Tremendous 12 has 12 stock picks that I think could be 10x in the next 10 years. And it's kind of like one of those things, 10x or bust. So they're a little bit speculative, but you can check that out by going to the patreon.com, Fired Up Wealth. There's also Gumroad, things like that. So, check it out. And there's a free Discord if you want to join, just see what the Discord's all about. And at the minimum, just subscribe. We do lots of stuff on YouTube as well. And the community is very, very large, and we're growing daily. So, are these, I've got a channel member here. He says, are the stocks you're confident enough to hold for the next 30 years? I'm never a buy and hold forever guy. I'm buy and hold and monitor. So if the story changes, you get out of the stock. So there's no such thing as like, I'm buying this stock for 30 years. It's like, if I buy something right now, like if I buy Snowflake, my plan is 2030. But if something changes, if the story changes between now and then I need to sell the stock and move on. So don't marry your stocks. There's no buy and hold forever. I despise it when people use that on Twitter and stuff like, here's 5 stocks I'm going to buy and hold forever. No, that's not a good way to invest, in my opinion. Upstart, we already talked about. Leverage into semiconductor index. Not sure what you mean there. Are you talking about like SOXL? I mean, that's high risk reward. It's more of a trading instrument. So up to you on that. Ultra Beauty, I don't really follow that space. It seems like an interesting one, but I'm not a retail type guy, so I apologize. Tesla, we talked about already in detail, so go back and watch the recording. C Limited, it's going to get traded with the China stocks. And so unfortunately it's beat down, and it was very expensive as well, but I still own some C Limited. I think it could be one of the, in fact, it's on the Tremendous 12. It could be a 10X or bust type thing. So Bros analysis was great. Thank you to Matt on that. Dave hates the 80s. Thanks. I appreciate that. Thoughts on Ping? I think that when you look at the identity management space with Okta and Ping and all those, I mean, there's so much competition. Even SentinelOne's even getting in the identity management space. And it's the first thing that's going to get breached. So every time those guys get breached, their stock sells off. So I got out of that space altogether, and I'm focused more on, you think of Web Gateway for Zscaler. You think of, Datadog for cyber monitoring. You think, I'm just talking cybersecurity here. CrowdStrike for endpoint security. And so on. There's videos in the channel if you want to see the stocks that I like in those space. I'm disappointed with Elon Musk and his political and Twitter circus. I have a large position in Tesla. Yeah, I mean, I don't know what to say on that, but thanks for your thoughts. Got to do some things around the house. Hey, Derek, thanks for stopping. Have a good day. And thoughts on Palantir. Palantir is good. I mean, it's one of those stocks that gets kind of thrown in the meme basket, but I don't think it is a meme stock, and I do own some, and it's been beat up, and there was a lot of dilution, so there's bear and bull case to it. I have it as a stock that I think could do well over the long term, but certainly it has had a lot of volatility. It got shot to the moon like a lot of them come back. So I like Palantir. I'm not a guy that does like a Palantir video every other day and and hypes and stuff like that, but I was the first person to bring Palantir to YouTube, and we bought it in Discord when it was $9. Never thought it would come back to $9, but crazy market plus dilution, and that's kind of stuff you get. So I like Microsoft. Cybersecurity arm growing 50% year over year. I like Microsoft a lot. I've owned Microsoft since 2012. So when I look at like a Microsoft, a Fortinet, a Palo Alto Networks, those, Palo Alto, for example, is in the top, 5 in 15 different segments, I believe. And you look like Magic Quadrant, and they're not always best of breed necessarily in those 15 areas. Like you look at like something like an endpoint, CrowdStrike's going to be the top, and then right next to it's Microsoft, And so we had this conversation actually just the other day in Discord. And in fact, on the live stream we did yesterday for the Patreon Discord community, we talked about cybersecurity, and we talked about this exact topic about how it's good to own things like Palo Alto Networks and Microsoft because they're very diverse and cover a lot of areas. If you buy something like a CrowdStrike, you're really taking a little bit more risk on that. There's a little bit more reward. It's a risk-reward thing because they're focused really on endpoint security. There's only a couple things, but they're laser focused, and they can be very agile and be best of breed. So if I'm a CIO and I'm building out, a cybersecurity stack for an organization, every organization is going to be unique and be different. And I might use those best of breed along with a Microsoft, along with a Fortinet, along with a bunch of different names. But generally, you're using tons of different names. And people ask the question, why wouldn't I just use Microsoft that does it all? Well, they might not be the best for your organization in specific areas, and you're going to kind of pick and choose to build that best of breed solution. So Enphase, a lot of people in the group like that. I've never done a lot of work on that one, but it seems really interesting, as well as STEM, I think, is another one that seems interesting. I disagree with your take on Confluent. Software for which you don't need to have anything Confluent open source. So yeah, Confluent, there's two versions of it actually. So there's two versions. Making some powerful enemies. Who's making enemies? Talking about Musk. Thoughts on Armor Residential? Don't know it. Clowning around. Good to see you. Lucas Jordan. What's your opinion with over allocation to the U.S. market or have a mix of Europe and Asia? It just depends on what you're into. For me personally, I live in the U.S. and I'm more comfortable investing in companies that I get to see and touch and use all the time. It's harder for me if I can't experience that to invest. I do have some like Mercado Libre, C Limited that it's one of those things where they're not U.S. based, but it just depends. If you go to a financial advisor, I'm not a financial advisor. He or she might tell you to diversify into X, Y, and Z, and that can work. It really just depends. The thing about investing, like what works for me and what works for you, completely different things. So there is no like right or wrong answer. Like if you are bullish on Europe and Asia stocks, I think that's fine. For me personally, I'm focused on the U.S. market. That's where I spend all my time, and so I'm trying to be a stock picker within the U.S. market primarily is really what I'm going for. So SoFi, yeah, I told the group if it gets in the fives that, it definitely was a buy because it was under price to book. And so that rallied nicely. If you look at a chart of SoFi, basically it bounced off of this 475 or whatever. So if you bought in the fives, it's already up to 750. So, I mean, you've made a 50% return or more if you bought at the bottom. I mean, it's pretty incredible the run that it's made. And look how beat down this thing was. So many of these names, it traded in this range for so long, between 13 and 25, and it just broke down. I never would have guessed that it would go to $4 and change or $5 or whatever. It's just pretty crazy. But it happens, man. It happens. So do you like Ford? I'm not a big Ford guy, but I don't really follow that space really either. So more of a dividend type play, and I own some Tesla, but I think of Tesla as an AI company. So thoughts on Adobe and Shopify? Adobe is a high quality company. I do have concerns maybe about moat on that one a little bit. Shopify, I like it. Stock's been beat up, but definitely like it. Been trying to add, especially as it goes lower. Idea of what the value of Cloudflare is. You bought at 70. Most of us bought Cloudflare in the 30s in Discord, and most of us were selling it at like 190 and 200. I do own 300 shares of Cloudflare. They're all house shares, so I don't have any cost basis on any of those at all. But if I look at, where's my cloud channel? Here it is. So right now, that one is actually trading at, it's basically the most expensive. I mean, Snowflake's higher, but Snowflake, again, is database as a service. So Cloudflare is a 17.4x EV/NTM. LTM growth is 53%. The gross margin is 78%. It's down 58% year to date. So it's still pretty expensive. You just have to, it's hard to say because the median right now on cloud stocks is 6.8x. The top 10 median is 15.1. The top 10 always has a premium. The top 10 is Snowflake, Cloudflare, Datadog, CrowdStrike, Zscaler, ZoomInfo, SentinelOne, Bill.com, Atlassian Team, and then MongoDB. And the top 10 median is 15.1x. So you could argue they're still really expensive. Fair value, hard to say. I think that when Cloudflare got down to its lows last week, it's wanting to hold 51, but I have this red line here that I drew for the team. I said I wouldn't be surprised if you saw 40, $45, something like that. It doesn't mean it has to happen, but I wouldn't be surprised if it came, another level down. If the market rolls over again, you're going to see it probably somewhere in here, but it could have bottomed. Hard to really say. And I made this example a couple weeks ago. If you bought Cloudflare at 70, okay, it was a $221 stock, and it could take years to get back to $221. But even if it took 4 years to get back to, if you bought it at 70, if it takes do some quick math on it. If it takes 4 years to get back to $140, I mean, it's probably going to outperform the S&P 500 if you're holding it for 5 and 10 years. It's not necessarily going to be awesome for this period that we're in, and it could continue to drift sideways or lower during that time. Anytime these guys, any of these companies have an earnings miss, they're going to get crushed, farther. So if you're buying these kind of stocks, you understand the risk. They're speculative, they're expensive, they can go lower, and you really have to have a very long-term horizon. And I tell most people that are buying these cloud stocks, if you don't understand them, don't buy them. And if you are buying them, they're probably in your spec bucket. And your spec usually is 5 to 10%. So let's see, user in timeout. Need to hide a user from channel. There we go. Somebody's spamming the channel. Not really sure why, but so yeah, if you got more questions, I probably missed a bunch. Hammer away, and we'll probably wrap this up here pretty soon and spend about an hour. And I got to spend some time with my kids this weekend. So, hey Russ, nice seeing you, man. Got to bounce. This was great. Look forward to watching more of your stuff. Take care. I know Russ from high school days. So Russ, I hope you have a great day and have a great weekend. So I think that's a good spot to end it, guys. I appreciate your time and attention. If you have not subscribed, make sure you subscribe. Check out Patreon. Hit like on this video. Come back and watch the recording. There's a lot of information you might have missed. And make sure you drop a comment on that left-hand side once the recording's up. So Have a great rest of your day, guys. I appreciate your time and attention.